It's been a rough ride in recent days for gold and silver. On the day of this recording, March the 19th, gold slides below $4,600, dropping back toward multi-week lows and rising oil prices, a stronger dollar, and a hawkish Federal Reserve. All of that weighing on the market. Silver is falling even faster, and mining stocks and ETFs linked to gold are also under pressure in early trading. Now, what's striking is that this is happening against a backdrop of an escalating Middle East conflict, a moment when precious metals would typically rally. Well, is this a temporary reset or a deeper shift in how markets are pricing risk? Well, joining us, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, thanks very much indeed for talking to us.
Oh, Devan, thanks for having me. Certainly, we are living in an interesting time.
We are, because every time we spoke in the past, gold had moved a couple of hundreds of dollars. There's no exception this time. The difference is it's moved the other way around.
It's simply gone up too much. So one fact about gold is it's 180-day volatility is running right now 2.4 times that S&P 500. That's not a store of value. That's a highly volatile speculative risk asset. So what it did is it shifted. It shifted from a store of value, and it's a classic case of a market that went up too much, and now it's a highly volatile speculative risk asset. And if stock market goes down, gold's going to go down more, and that's what's happening. But I like to lean over to silver, the devil's metal. It was up 63% on the year in January. And right now it's down 3% on the year. It's living up to its reputation. The lessons you learn in things like silver, which is, answers have changed a little bit. It's much more of an industrial metal now than in the past, is you never want to buy it after it goes up. And that's what's happening. So now the question is, where does it go from here? I fully expect this year to be a down year for silver. I fully expect the peaks in gold and silver to last for years, maybe decades, if history is a guide. And it's just a question of what stops. And now we've reached some maybe first support, but gold, as we speak, in the morning of March 13th, gold's still up like 7% on the year. So if it follows silver, and even copper yesterday, copper shifted and tracked down on the year after making a record high. That's what commodities do. And it's what I just point out to people all the time. It's just trying to pick those tweaks. And I'll end with this. The key lesson you learn in commodities is what I learned in the trading pits, a little more trading pit vernacular, was markets go down because they went up. And what I learned on the Wall Street trading desk is the word autocorrelation. These things are just autocorrelated. They go down because they went up.
All right. So let's look at this frame here, Mike McGlone. We are seeing oil absorb the safe haven bid instead of gold. Is that the situation? Is that a temporary shift, you think, or a sign that the market is repricing what safe haven actually means?
It is right. Well, here's a lesson you learn in bear markets. I've learned being at a hedge fund for years is bear markets can take money from everybody. And the only market that's really up this year, as you mentioned, crude oil, but it's really harder to invest in. And you look at the broad market, the Bloomberg Commodity Index is up almost 25%. Yep. I've been comparing that to 2008. In July of 2008, the Bloomberg Commodity Index was up 30% and ended up the year down 36%. I see inklings. I think that's going to happen this year, partly because we do have a very determined U.S. administration led by one key person who has said that's going to happen. Now, he might be wrong, but he has the ability to do it. And just a few comments we saw from today where Scott Bessent has mentioned that the U.S. might have a privy to some of Iran's crude oil and the back of Venezuela, the back of the massive supplies by this country. Is everybody gets what's happening. All traders get it. They know this pump is much more likely to lead to a dump in crude oil. It happened in silver. It happened in Bitcoin. It's happening in gold. And the key thing to keep things elevated, you need that straight to stay closed. Yep. That's an unprecedented event. And I think, underestimate right now, this is a major faux pas. It's a major mistake. I fully did not expect the trade would be closed. I figured the U.S. military would have had this cleaned up by now, but I've been wrong. But now that it has closed and we have this event, we have a global tilt towards a global energy crisis and significant recession. That's what's happened in 2008. Crude oil can be its own worst enemy. It pumps and then it dumps. But right now, what's happening, it's happening as we already started seeing pretty waning consumer sentiment. We've seen people very fearful of losing their jobs from AI. This is a global recessionary trajectory kicking in. So let's say we wake up tomorrow and the Strait of Hormuz is secure, everything's fine, and the offensive capabilities of Iran have been repressed. I don't know how that happens, but say that happens, would get a relief rally, but it doesn't matter. I think everything started to tilt towards that scenario. That the bottom line I look at it is, and I can show you in one chart.
Before you do that, Mike McGlone, let me just put this
Yeah.
question to you, because you touched on it. I mean, if that disruption around the Strait of Hormuz persists, does oil effectively become the dominant safe haven in the cycle? And you can bring up that chart that you spoke about.
Yeah, it already has. A key thing about safe havens, as we've learned from what happened in gold this year, is you don't want to buy a volatile risk asset after it goes up, or even gold was the safe haven. And I want to show you one reason for that, and that is, this is a key theme we have right now. This is stock market volatility. This is NASDAQ volatility, 180 days. It's hovering near an 8-year low. So that's kind of what's happening. And, we things tilting low. I'm just giving a leading indicator. Bitcoin's broken down, NASDAQ's broken down, yet volatility is still low. But as far as a safe haven, no, I would not suggest anybody buy crude oil is a safe haven. First of all, you have to hold that crude oil. Typically, it costs money to hold it. It's in backwardation right now, which means you actually get paid to hold it. That's rare. That's wonderful for people who bought it and held it, but that's quite rare. And the key thing to remember about crude oil is its own worst enemy. It's the most autocorrelated commodity, and right now we're seeing Brent near 111. Virtually every single time in the last 20 years, it's got to near 120. It goes back down to 40. I see that happening potentially this year. And now, how the straight works out. Now, that's Brent. Let's look at TI. TI is at 97 at the moment. That's WTI, US. Why? Because there's a massive surplus of crude oil, energy, natural gas, corn, soybeans, and wheat in the US. So who has the upper hand? And traders get that, but I look at safe havens right now. I stick with my key theme for this year is U.S. Treasuries will probably be the best place to be. Now, they're unchanged on the year. Okay, well, I guess that's okay with everything falling. For now, a broad commodity market might be a safe haven because you get, that wider exposure. And I used to look at metals as a safe haven, but they just went up too much and they're starting to go down. So sometimes, like I said, it's the best way to just get away from markets, wait for opportunities. That's still my theme for the year. And my key theme for the year I showed in this chart is this volatility measure will go up. It hasn't gone up yet. And I want to show you one other thing. And we show you one other thing. We get to the next question. Right here, this, I guess you can just aqualine. That's 60. This is what I'm showing you is the measure of markets for the year. My key theme was sell the opening in 2026, which might mean first quarter if you include crude oil, and buy the close, which probably means the end of the year. Now, I want to show you one key thing that's happened this year so far. 60-day volatility on the S&P 500 has dropped 10%. That's kind of a shock. That, I think, should be up 20 to 30% before we really consider buying risk assets. But one thing that's happening is gold has rolled over. Copper has reached down in the year. Bitcoin is leading the way. All these risk assets in the stock market starting to tilt lower. I don't think this is going to stop. I think there's going to be bounces. But the bottom line is I think this is just getting started because one of the key reasons is maybe some people can already detect I'm an ex-option trader, is volatility means everything. And this is the key theme I have from this chart is this volatility should go higher. It hasn't yet in the stock market.
Well, that's interesting. As you bring yourself back to full screen there, Mike, how much of this move comes down to dollar strength? You've touched on it in your previous answer, versus fundamentals in the metals themselves.
Well, dollar strength is definitely part of it. So it's been the safe haven. It makes sense. But how strong is it? The key thing is 2% on the year. I guess year to date, dollar is up less than 1%. It's 1%, but it was down much more before. So that's part of I think some of the typical move. It's not a big deal, but I don't see the dollar as a major player at the moment, and partly because you see a major offset. It's when you measure the dollar versus a basket of trade weighted securities, the measure from the Fed, which one's better over the long term? Okay, first of all, U.S. right now has relatively high yields, the deepest markets in the world compared to, let's say, certainly Asia, China. Their 10-year note yields 1.8% in this country. It's 2.6%. Europe, most of those 10-year yields are 3 and 2 handles. And they're talking about tightening. Okay, so that might be bad for the dollar. But the macro is, look at the post event now. Let's just look at midterms. So far, things have to go really bad, I think, for the dollar to have a problem with what Mr. Trump has initiated here. And I have to point out his mess so far. But it's a mess right now, but it's going to be cleaned up. Let's just look back. Let's look forward to where we probably will be by midterms. This will be cleaned up because the U.S. and Israel and now Saudi Arabia and a lot of the other people here are starting to just say, all right, we're going to just pound them into submission. As we get to midterms, they'll probably be able to say, I think Trump will be able to say, okay, we had this unlimited friendship between Xi and Putin. And since that started in 2022, they've lost Syria, Venezuela, Iran's on the way, and potentially Cuba. That's what gold sees. Gold saw the risk going in last year, and gold sees a secure world coming out of this, where this kind of access of, I guess you could say, aggressors right now, because is going to be diminished. And I think gold already priced for it. It's too late. It's over. Trade's over. So things have to get really bad. And the way I see it now is the stock market doesn't care. It will care because I think this is going to tilt consumer sentiment, like 9/11. 9/11 was, we were already in a bear market. 9/11 flipped things. And the big difference, I'll end with this, is I like to compare to 2008, which to me this is very similar in some ways. With the energy spike, is when we walked into 2008, stock market cap and the GDP in the U.S. was 1.2 times. At the end of last year, it was 2.3 times. And I pointed out volatility was near a 10-year low. To me, this is just normal reversion, and it got a good spark.
Mike, let's shift focus on the silver. I mean, you said something very interesting about what you see is going to happen to silver as this year progresses, right? Silver has come off sharply from those recent highs. Again, a fundamental question, is this normal volatility or the kind of move you see as a major turning point? I would imagine it's the latter for you.
Yeah, definitely the latter. But the key thing about the hardest thing as a strategist in markets sometimes is to sell when stuff goes up and you make a lot of money. And also it's selling when they're yelling. The classic signs in silver were just getting above $100 an ounce was just silly. And then everybody points out the fundamental things that people like us who've been bullish metals forever pointed out 5 years ago or 3 years ago. And that's a classic sign of a peak. To me, the whole metals complex looks very similar to the crypto market last year. Up too much. That was a little more speculative. Metals have been my favorite sector. Silver is a significant metal. It's a great leading indicator. It's one of the highest volatilities. But I like to bucket into all metals. Is we created the Bloomberg All Metals Index almost 10 years ago because I asked our index team to do it. It's the best place to invest over time. But just at the end of February and March, it reached the highest ever versus broad commodities. And that's the lesson you learn in commodities. It's autocorrelation. They went up too much, create their own messes, risks and go down. But silver is an industrial metal. Industrial metals index is basically flat on the year now, is up almost 20%. And the key things you need for that industrial metals index, silver, copper, aluminum to go up. Number one, you need demand pull from China. And China's already in a deflationary trajectory. The yield at 1.8%. They are completely dependent on massive fiscal and monetary stimulus, almost many multiples of what you've seen in the U.S. And they're dependent on exporting to the rest of the world in the U.S. And that's being shut off. Yeah. And another key thing, the bottom line you need, I'll end with, is you need the stock market to go up. And my base case for this year, stock market volatility will go up, which means we're way overdue for 10 to 20% drawdown in the U.S. stock market.
Wow. So, Mike, listen, how are you viewing what's happening with interest rates, right? You've got this oil scenario happening, inflation on the other side is going up. Central banks look at this and go, well, especially the Fed looking at this and go, well, what's going to happen with rates? And typically no cuts on the horizon here, How do you factor this in when it comes to metals, and how's it connected?
Well, I'm going to show you another screen. I think treasuries will be the best place to be this year. I guess I can say I've been somewhat wrong. They're unchanged. Abroad, the 20 plus TLT with income, that's the major iShares bond ETF. And the Bloomberg U.S. Treasury 20-plus year index, right now in the year is flat, despite the S&P 500 being down 3.5%. But by the end of the year, I think what I see in this chart is going to happen. And what I show you in this top line, that's the U.S. stock market cap to GDP. It's just starting to trickle down. Yeah. And then I show you the ratio of gold versus a 60-month moving average. It was the highest in almost 50 years. It's just starting to roll over. And the bottom line is all this is happening. We're seeing this massive wealth creation, and CPI is hovering below 3%. Now, it might pop up above 3%. It did in 2008, and by 2009, it was minus 2%. I see parallels. I think that's what's going to happen. I think CPI is going to drop towards zero maybe by next year, on the back of one key factor, just a little bit of normalization in the most expensive U.S. stock market in about 100 years, and stock market volatility, 180 days staying near a 10-year low. We've had the spark. So it's called post-inflation deflation. You spike that inflation, most notably from when you do it from crude oil, like we did in 2008, it shuts off that demand, massively picks up supply. You're already seeing that in the Western Hemisphere, and notably the U.S. landman is loving this, and it tilts the world towards recession, which means that deflationary force. To me, that's what's going to happen this year, and I don't see what stops it at this juncture. But remember, when we walked into this year, like I said, we were the most expensive U.S. stock market in 100 years. CPI was already hovering lower, and gold was just silly expensive. So this is just a normal reversion year. I think we're going to look back from history and say, yeah, we're overdue for a little bit of normalization in markets.
Okay, I'm going to end by just putting you on the spot. Yeah, I want your medium-term and long-term sort of look, given the numbers that you're just quoting. What is going to happen with gold in your view? Medium-term, long-term.
I think the highest. I think gold initially goes back to 4,000, and I think it's going to languish for years or decades. So the key thing I'm worried about gold is over time, you take the price of the total return S&P 500 divided by gold, it always goes up. That stopped in 1997. If you had bought gold since 1997 versus the stock market, you're even breaking even or beating the stock market with lower volatility. That's a bit of a historical aberration. Gold to me just got way too expensive. I get it. But the world's going to be a safer place after the closing of this, after the Strait of Hormuz is cleared up and Iran has been capitulates a little bit. To me, this is the safer world. That geopolitical bid in gold is over. We're going to see deflation, which is sometimes actually good for gold. But for now, the peak, I think this year will last for a long time. And I don't know what's going to take them to get bullish, just like cryptos. I don't know what's going to take them to get bullish. And right now, I think they're just reverting excessive bull markets.
Yeah. Well, Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence, always great to have your insights. Thanks very much indeed for talking to us.
Thank you, Devin. It's my honor and pleasure to be on, and I'm looking forward to the next time.